Today, we're going to put a multi-billion-dollar company to the test, but we're not using some complex algorithm or Wall Street secret. We're using this simple, incredibly powerful checklist of one of the greatest investors of all time. We are analyzing the real estate giant, JLL, the Warren Buffett way. You know that feeling, right? You pull up a stock and you're just hit with this wall of numbers, ratios, and acronyms you've never seen before. It feels totally overwhelming, like trying to read a book in a language you just don't speak. But what if I told you there's a way to translate that language? A way to use just a few key clues to find the real story, the treasure map that's hidden inside all that data. Well, that's exactly what we're going to do today. So, how are we going to do this? Well, we're basically going to steal a page right out of Warren Buffett's playbook. He doesn't use a crystal ball, he uses an investigative checklist. It's all about just asking the right questions to figure out a company's quality and its real value. And, it all boils down to a few core ideas. Now, Buffett's number one rule is to only invest in businesses you actually understand. We know JLL is a huge player in commercial real estate, so we can check that box. That lets us focus on the two questions that really unlock value. Is the business financially healthy? And are we buying it at a fair price? Let's see how JLL stacks up. All right, first things first. Is the business itself on solid ground? I mean, a cheap stock isn't a bargain if the company is sinking, right? So we'll start by checking a couple of key vital signs for JLL's financial health. First up is something called return on equity, or ROE. The easiest way to think about this is like the company's report card. It tells us how good the management team is at turning shareholder money into actual profits. And just like in school, a higher grade, well, that's almost always better. So what's JLL's grade? It comes in at 10.56%. That means for every $100 investors have in the company, the management is generating over $10 in profit. And as a general rule, anything over 10% is usually a sign of a pretty well-run business. And see, this is exactly what Buffett means when he says this. He's not out there hunting for cheap, broken companies. He's looking for wonderful companies first, profitable, well-managed businesses. Then, and only then, does he even start to worry about the price. Okay, next up on our little health check is the debt-to-equity ratio. This one is simple. It just tells us how much the company relies on borrowing money versus using its own funds. A company with too much debt can be really risky, especially if the economy slows down. And wow, this is where JLL really shines. Its debt-to-equity ratio is just 0.22. That means for every dollar of its own money, it only owes 22 cents. In the real estate world, which can get pretty volatile, having low debt like this is a huge sign of stability. The financial health check? So far, so good. So we've established that JLL looks like a healthy, well-run company. And that brings us to the second and super crucial part of the checklist. Is it selling for a good price? The first tool for this is the price-to-earnings, or PE ratio. You can just think of it as the price tag on the stock. A lower PE often means it's cheaper. But just like any price tag, it doesn't mean anything without a little context. So right now, JLL's PE ratio is about 20. But here's the context we need. Its average over the last few years has been over 24. This is our first clue. It suggests the stock might be on sale compared to its own recent history. But a simple price tag isn't enough. We need to know if we're getting a good deal for what we're buying. That's where the PEG ratio comes in. It connects the price to the company's expected growth, telling us if we're paying a fair price for its future. And JLL's PEG ratio is just 0.46. Now, as a rule of thumb, anything under 1.0 is considered a potential bargain. This number is, well, it's very compelling. It suggests that not only is the price reasonable, it might be downright cheap compared to the growth that's expected. And all of this brings us to the holy grail of value investing, the margin of safety. This is Buffett's ultimate risk management tool. The idea is to figure out what you think the company is truly worth, its intrinsic value, and then buy it for significantly less. That discount is your buffer, your cushion against being wrong. So when you put it all together, one financial model estimates JLL's intrinsic value gives it a margin of safety of 34%. In simple terms, this suggests the company might be worth a third more than its current stock price, giving investors a huge potential cushion. So let's pull all the pieces of our investigation together. We've looked at JLL's health and its price through this Buffett-inspired lens. So what did we find? Let's look at our scorecard. Is it a healthy business? A solid ROE and very low debt say yes.
Is it a fair price? The data suggests it's trading at a discount to its history, with a fantastic PEG ratio and a potential 34% margin of safety.
Now, it's so important to remember this isn't investment advice. This is not a recommendation to buy anything. The goal here is to give you a mental model, a framework for thinking like a detective, and using a few key numbers to build a story about a company's quality and value. Because this process of just asking simple questions, is it healthy? Is it cheap? It can transform that confusing wall of data into a compelling narrative. So the ultimate question we're leaving you with is, what other stories are hiding in plain sight, just waiting for you to uncover them?